Hey guys, Whitney here. Welcome to our Passive Investing Made Simple show. If you haven't ever joined us in one of these shows, we do this show live every Tuesday to help you learn the ins and outs of passive real estate so you can go into your next or first deal with confidence. Anyways, today's topic, we're going to talk about funds, portfolios, and single asset entities. What are the differences between the two? Which is right for you? Just kind of all the ins and outs. I hate to say pros and cons because really it really depends on your investment goals and what you're trying to do. Now, guys, before we get started, be sure to find your Q&A box. Help me stay organized today. And if you have any questions throughout a presentation today, be sure to drop them in that Q&A box. For those of you here that are huge Taylor Koo fans, he unfortunately had a scheduling conflict. He will not be joining us today, but he will be hosting you guys live at the end of the month when I have a scheduling conflict. So we're sorry to miss out on Taylor. Anyways, let's go ahead and dive in and get started. So if you don't know me, this is the whole reason why I invest in real estate, and specifically passive real estate. I started off as a real estate investor completely by accident in 2002. It's called living, flipping, and house hacking. That's the strategy that I engaged in for several years, and then scaled up through buy and hold real estate, single family homes and small multifamily homes. And then my husband and I hit a level of achievement, and we didn't know how to break through that. And eventually we landed on that we needed to pick up bigger deals faster in order to hit our passive income goals for ourselves, to really achieve financial freedom, break that paycheck independence, to have freedom of time and choice, freedom of location independence. And we decided that we needed to do that through larger scale real estate, not just ones and twosies, but like hundreds and 500 unit portfolios to pick up. And we did that actively and passively. Now, fast forward today, we have over 6,500 residential units under our belt, 2,200 self-storage units, 7 express car washes, and a myriad of other investments. But again, these, if you know me, people love to see numbers, but these are just metrics. This actually isn't the result. The result that you get by building and scaling a portfolio like this actively or passively is, what are you rowing towards? What is your North Star? And for us, we wanted 100% control and choice on how we spend our time. That was our number one thing. And for us, passive real estate is really that asset choice that got us to 100% choice on how we spent our time. Because when you're doing things actively, when you have short-term rentals that you're managing actively, your single family rentals you're managing actively, or maybe you're a syndicator who's buying active real estate, you have to figure out how to scale yourself out of your business in order to get your time back. Or if you're a high income earner whose highest and best use of your time is in your job, guess what you can do? You can invest in other people's projects and get that scale and leverage immediately. And we can help you do that at passiveinvesting.com. We have over 1.3 billion assets under management, 26% IRR to our LP investors, and over 27 months, a 56% increase in valuation on our deals. Now, today's topic, we're diving into the differences between funds, portfolios, and single asset entities. Now, if we touch on anything that you might construe as financial advice, legal, or tax advice, guess what? You need to put a pin in that and take it back to your team and consult with them before acting upon any of that information. All right, guys, so let's dive in. Now, I'm going to flip around how I normally kind of break down a topic, because we're talking about funds, portfolios, and single asset entities. We really need to understand why first that we need to know about these and the pros and cons. And that is because as a passive investor, once you set your investing goals, your time horizon, and your risk tolerance, you only get to control 3 things, and that is who you invest with, where you invest, and what deal you go into. And we have to make sure that those 3 things align to your goals, your risk tolerance, and your timeline horizon. Okay, so that's the biggest why, that you have to understand this. Now, for many of you on here, you're gonna many of you are going to be drawn to one thing or another, whether it's funds or portfolios or single assets, and you're probably going to be very passionate about why you love investing in that area. But just as you might be passionate about why you invest in that particular area or that methodology, there's somebody else on this webinar that is going to be just as rooted in their methodology, and they're going to think very counterintuitive to you. And why is that? It's because they have different goals. Maybe they have a different risk tolerance and a different timeline horizon. Okay, so that's the number one thing that I see investors do, especially when they start getting into passive investing, is they borrow somebody else's investment thesis, somebody else's goals. Okay, and then they try to copy that, right? Success leaves clues. I've been there myself. You try to copy somebody else's plan, and then you pick your head up one day, you're like, oh man, that was their plan, not mine. I need something different. Okay, so I hound this all the time in our boot camps that we do. You can take advantage of those boot camps here at passiveinvesting.com. We hammer home this exact thing: knowing your goals, risk tolerance, and your timeline, so you can get in with the right operator, in the right market, in the right type of deal structure. All right, so, okay, I can continue on that why forever, but let's dive into what each of these areas are. And then kind of like the pros and cons, like what are the advantages and disadvantages of doing this? Well, the first thing we have is what we call a single asset entity. Now, typically in a single asset entity, especially when we're talking about passive real estate, you're investing in an LLC or a limited liability company that owns real estate but has no other assets. So think about this, especially if you've been an investor with us. Our multifamily largely are single asset entities. We buy one building, we put it in an LLC. Investors purchase shares in that LLC. There's only one asset in there. It's very visible. Okay, you can see the asset. You know what the asset is. You know what market it's in. You know all the deal specifics down to the loan numbers, the trailing 12. You know everything about it. It's very visible. Now, you also have investment minimums when you come in, start investing in single asset entities. And this is where some investors get stuck, is that they're like, this is going to take me a lot of cash to diversify if I'm investing $50, $75, or $100,000 in each single asset entities. Okay, each of these single asset entities. Now, I actually challenge this a little bit, because if you have never heard of this, there is a platform called TribeVest. This is not a recommendation, but check it out, because you can actually form your own LLC that invests into the single asset entity LLC. Now, with that small LLC, now you can partner with your family and friends or other tribe of investors and break that up and get that diversification. Okay, it's one added step, but that's just a little pearly nugget there if you've never checked into that. Okay, but this is what a single asset entity is. You're going out to buy one building, one house, one self-storage center, and putting it in an LLC. Okay, now the next thing we have is a portfolio of assets. Okay, so in a portfolio of assets, it's typically still an LLC, and it owns a collection of assets. Okay, for us, if you're an investor here with us, you're probably very familiar with this with our self-storage and our car wash deals. We put 3, 5, 7 assets in one LLC in order to, one, create instant diversification for our investors. Okay, and that diversification is across market and deal. So sometimes the minimums on these type of deals inch up a little bit, might be 75, 100,000. I've seen some portfolios deals that are $150,000, $200,000 minimums. You might be scratching your head like, why would I invest $200,000 into one LLC? And it's because you're actually diversifying. Say there's 5 assets in that LLC and you're investing $200,000. You're actually investing $40,000 into each one of those assets. You automatically got that instant diversification. Now, what I love about portfolio of assets is that they're still visible. So you still get this great visibility of the asset. You know what asset's being purchased, you know where it's at. You can see the lending, that's being placed on the portfolio assets. You can see all that. Okay, it's not blind to you as an investor. You get to ask questions about it. However, you do have to understand when you invest in a portfolio asset, you may be getting up a little bit of control on what markets you go into, what timelines are associated with the assets, and there is a possibility it could be partially blind. Okay, I like them because they're generally visible, but every once in a while, I've seen a deal out there where it's like, here are 7 assets we're going to put in the portfolio, and we can only show you 5 right now. Okay, now there might be a specific reason why you can only see 5, but it could be partially blind. Now, when you invest in a portfolio of assets, generally the operator is going to sell when they exit the entire portfolio at one time. They're not going to piecemeal out the assets and leave you 100% invested as they roll them out. Okay, so they're going to try to sell everything at one point in time, which means you'll have to have a different buyer for that portfolio. All right, and then we got our last type of asset, which is funds. Okay, and this is where a fund is unique. I think a lot of people think a fund is an asset of itself, but really what a fund is that the sum of money or other resources whose principal or interest is set apart from a specific objective, typically to invest in many assets. So essentially, when you invest in a fund, you're not investing quite yet in the asset. You're investing in the operator's thesis of what the asset is going to be, or assets are going to be in that fund. And you're preceding the fund, you're getting the operator money, and then they're now going to execute on the business plan and go buy the assets. So some great things here about funds is that you can get greater diversification. Okay, so maybe a fund is going to go purchase 20 buildings, self-storage buildings. And you can precede that fund, and the operator now is going to go shopping and try to close all those deals. Oftentimes in funds, when a fund first opens, the earlier money that comes in is going to get an incentive for joining early. So even though the typical split in a fund may be a 70-30 general partner, limited partner split, 70% to the limited partner, 30% to the general partner, maybe when the fund first opens, the general partners actually say, you know what, we're going to give an extra 20% backup and bonus for the first 10 million that comes in the fund. Because what they're trying to do is incentivize that early money to come in so they can go shopping for those first few assets and start putting them in the fund. And as those assets start earning their placement in the fund, later money, that incentive bonus generally goes away for later money. But there's a trade-off there, because now the later investor can actually see the assets. They're not getting visibility of what's already in the fund. And so they're trading that back-end incentive bonus for greater visibility and on being able to see the assets in the fund. So again, funds can be great, for diversification. Cons are that you're definitely giving up visibility into the market and the asset specifics. You're more than likely giving up a lot of control on the timeline. A lot of funds take longer to unwind. So those funds generally are going to be locked in for 5 to 10 years. They're not going to be able to cycle out nearly as fast as single asset and small portfolio entities. Now, I say that as it's a truth. It may or may not be true, because it all boils down to the operator. And so for me, when I look at funds, evaluate funds, I have to have immense trust on who the operator is. Immense trust, because that's who I'm investing in. I'm investing in the operator and their thesis of what they can execute on. Now, for me, when we're investing in a fund right now, one of the things that really makes me nervous is, you're investing in an asset right now, and the operator's thesis is that they can get a 7% interest rate on that particular asset. We saw this last year. What happens in 6 months if interest rates continue to go up? All right. there's an interest rate risk there. How is the operator going to handle that risk? Do they have it already stress tested into their fund? Are they going to have to actually trade what class of assets that they're going to go after in the fund in order to offset that interest rate risk and still be able to deliver the returns to the investor? Or if interest rates go up, is that a risk the investor is actually automatically taking on and that the operator is going to pass through, and that they're just communicating, hey, by the way, over the next 6 months, interest rates can go up and you as the investor need to be prepared for returns to adjust downward. So these are all the questions that I encourage you to ask around investing in funds. Now, how do you know which of these strategies is right for you? Do I invest in single asset entities, small portfolios, kind of get a balanced blend of both, or do I go right for the funds? Well, the first question is, what do you need from your portfolio? Okay. Do you need capital preservation, cash flow, equity, tax benefits, diversification? Okay, this is very, very important. This also is a kind of a proxy indicator for where you might be in your investing journey. Okay, so somebody who's earlier on, maybe investing in their late 20s or early 30s, they may have a longer investment timeline horizon and can take on larger risks should they choose to do so. Where somebody who's close to nearing retirement, maybe they don't want to take on those risks and they just want to have that immense visibility and eliminate a lot of those unknowns in their portfolio. So again, what goal do you have? Where are you in your investing journey? That will inform which type of asset you could be looking at. What is your risk tolerance? Okay, are you like willing to take on this interest rate risk? Do you like blind versus non-blind funds? Does it really not impact you a whole lot? There's also kind of a consolidation risk here. And what I mean by this is when you invest in small portfolios and funds, as they continue to scale up within an operator, sometimes these things get consolidated. And so as you allow 1031 exchanges to happen, you're going to have more and more percentage of your portfolio with one operator in one particular deal, maybe even in one market even. So there's a consolidation risk there. All right. And then also timeline horizon. Okay. Single asset entities, I'm not saying this is a truth across the board, but I see a lot of single asset entities cycling out in 3 to 5 years, maybe 7. The operator can be a little bit more nimble with the single asset entities, maybe a small portfolio. The funds take longer to get fully vested in, and they also take longer to unwind. So what is your timeline horizon? All right. And here's the thing, your goals will most likely change over time. And so I would expect the compilation of holdings in your portfolios to change with those goals. All right. Many investors here might be experiencing this over time. Like you started off 10 years ago investing in single family real estate, and then you started scaling through small multifamily, maybe got into a few active multifamily deals or larger portfolio deals, and then started getting into passive real estate. So as your goals changed over time, so did the structure of your holdings. Okay. I know people, passive investors that have 40, 50, 60 K1s investments, passive investments that they manage. And so, whereas they were their first passive investments, they're placing, 20, 50, maybe 75K in. Now they're looking to write bigger checks into deals that help them get that diversification. Okay, again, it all depends on where you're at in that investing journey. All right, guys, this is the topic that I have for you today. Again, there is no one right fit for everybody. Okay, this is really going back to what is most appropriate for your portfolio is based on your goals, your investment timeline horizon, okay, and then what kind of risk you're willing to take in your portfolio. I hope this has been useful, demystifying the topic between what a single asset entity is, portfolio, and funds. If you have any questions, feel free to reach out to me at Whitney@passiveinvesting.com. If you're here live, don't go anywhere.